It's time now for our Muni moment. And it turns out that Munis are having their moment, a rare haven against losses that hit other fixed income securities in June. Joining us to talk a little bit more about this, Sean Carney, head of municipal strategy over at BlackRock. And I was looking at some of the returns, at least based on the Bloomberg indices. This was kind of a sleeper, if you will. Everyone was so focused on some of the gains in equities and other areas of fixed income. What gives, Sean? What provided that boost?
Good afternoon, Romaine. It has been a good run. Munis turned in a very good June on the back of higher rates and there being a bit of a safe haven bid in the muni market. As you know, it's kind of an up in quality trade. So as U.S. Treasuries were selling off a bit, munis benefited. We also have a very strong technical in the muni market right now where there's not a lot of supply, but a good amount of demand. So I think that also aided the performance that we've seen recently.
What happens next, Sean? Because there's obviously a lot of concerns about just seasonal factors that would normally affect the muni market, and then, of course, overlay that with just kind of the wacky conditions we're in right now, given economic conditions and the Fed tightening cycle. Can we expect some of these gains to continue through the summer?
I think we can expect them to continue. It's just important where they come from. And there's a strong seasonal also in the rates market come July and August. So if rates are trending lower, as we're seeing today on the screens, green on the screen for U.S. Treasuries, munis will do the same, just, potentially at a lesser degree, given the richness that munis come into the month of July having. The good news is the retail buyer cares more about all-in yield than they do ratios right now. So yes, it can continue, and we look for it to continue. However, a bit of caution coming in here with where relative value stands is certainly warranted.
Well, even with the strong June that we saw and the expectation that it will continue, maybe to a lesser extent, but still continuing. If you take a look at the flows both on the ETF and the mutual funds side, they've been pretty hot and cold, Sean. What's it going to take to really see steady inflows from here?
That's right, kid. That's a great observation. We've seen more money coming in the non-traditional portions of the muni market, ETFs, SMAs, ladders, as opposed to, into mutual funds, which is what fund flows calculate. I think it's going to take a sustained period of less rate volatility, perhaps getting confirmation that perhaps July could be the last Fed rate hike, or even if July is not a hike, if they were to pause in September, it gives them a 98-day window before they could be active again in November, which is a good size window. So just a little bit of stability in rates could go a long way for fund flows in the muni market.
And Sean, maybe this is unfair, but when I think about the typical muni investor, I think of someone who's pretty risk averse. And, when you think about sort of what we could see when it comes to cash, if the Fed does stay on hold for a while and those rates remain high, what is the pitch to buy muni bonds versus just going into money market mutual funds?
Yeah, good point. Cash has certainly been an alternative in this market. I think, though, the conversation needs to turn to building some durable yield into portfolios. We know what happens after the Fed stops hiking, and front-end yields fall very quickly. So while they're attractive today, if we are getting closer to the end of the Fed, those rates will not be there for long. Putting some duration in the portfolio, building some durable yield in the portfolio, as we like to say, seems like it's good. You only have to go out 15, 16 years on the muni curve to pick up 90% of it. So, good, responsible trade, adding some durable yield, putting on a little bit of duration ahead of when the end of this rate hiking cycle does commence.